around the use of machine learning in finance. And in this presentation, I would like to introduce you to 10 applications where machine learning delivers measurable results. Machine learning is the empirical tool that we need in order to model these extremely complex systems. At the same time, it should be clear by now that machine learning is no panacea, is no holy grail, is not going to do things magically. In fact, as powerful as machine learning is, it's extremely easy to misuse. Let's start with a very simple definition of what machine learning is. And there are plenty of definitions out there. That's why I want to set the stage with a common definition. The idea of machine learning is how can we learn complex patterns from the data without us imposing a particular structural form. And that's the key difference between traditional statistical techniques and modern statistical techniques. In traditional statistical techniques, we impose a structure. We impose a specification. Think of when you took classes of linear regression or econometrics, etc. The starting point is always in a specification. We are forcing the data to fit that specification. We are not allowing the data to tell us what is the structure of the data. That's a key difference with machine learning. When we use machine learning techniques, we want to understand the structure of the data before we introduce our biases. The second main difference is that this search occurs in an undirected manner. The algorithm is going to learn something that we don't know. The algorithm is going to uncover some relationships that we were not aware of. These patterns are detected in a very high dimensional space, in situations where there could be more explanatory variables than observations, potentially. And these patterns may not be representable in an algebraic form as a system of analytical equations. Let's look at this plot. As you can see there, I have a heat map of a correlation matrix of various investment-grade corporate bonds. It seems like a mess. Apparently, there is no structure there. If we were to use standard methods, what we would do is we would take this correlation matrix, compute some optimization using convex programming, for instance, and obtain some results that give us, for instance, an allocation to these bonds. Now, if we apply a clustering algorithm, this is what comes out. All of a sudden, we uncover a hidden structure in the data. Why is this useful? Because if we understand this hidden structure in the data, we can use this structure to answer our questions. We can use directly this structure in order to model the data itself. Let's look at the simple example where machine learning shows its power, its flexibility. Suppose that we wanted to estimate the probability that a particular passenger in the Titanic would survive. If we were to use traditional methods, we would apply, for instance, logistic regression. We would try to estimate the probability as a function of some predictors, where the predictors could be the gender of the passenger, the age of the passenger, the fare ticket, whether it was first class, second class, third class. And the forecast would be horrible. Why? Because this logistic regression would not understand the hierarchical nature of the problem. If instead of using a logistic regression, we use, for instance, a regression tree, what we would find is that now this data exhibits a very clear hierarchical structure that we can use to understand and to make these predictions. And this is an example where the most important variable to predict whether this passenger survives is gender. And then within gender, depending on the gender, it could be relevant, the fare class ticket. So for instance, if you are a female, and it doesn't matter if you're in first class or second class. However, if you are a male, there's a huge difference between being in first class and second class. This is the kind of interactions that traditional statistics are unable to model. It doesn't matter if we use you take any model that is typically taught at econometrics courses, and they will fail. Why? Because they do not incorporate this class of decision tree or decision-based splits of the data. All of this has happened very quickly. 10 years ago, machine learning was essentially unused in finance. Why? Because there was no sufficient computing power, there was not sufficient data, and even the mathematical methods were not well understood, meaning that what worked in machine learning elsewhere would not necessarily work in finance. And what we have seen over the past really 10 years is a complete transformation of the use of these techniques outside of finance and within finance. Now, the key question here is, can these models predict the past or predict the future? Big difference. And let me give you an example. On May 6, 2010, I was managing a large high-frequency trading book at a well-known hedge fund. And around noon of that day, for the first time since we were running this strategy, the algorithms flattened our positions automatically. So over a matter of 10 minutes or so, the algorithm was running a large book, and within 10 minutes, the position was flat, no position. And that happened around noon. Of course, when you run a high-frequency book or any systematic model, you let the model do its thing, and then you look at the logs. And we were looking at the logs, trying to figure out why the algorithm had flattened the position for the first time ever, when around 2 p.m., 2 hours later, the flash crash occurs. If you remember, during the flash crash, in a matter of minutes, the stock market fell 10% from the opening, and nobody knew why. Everybody was puzzled. Some people thought it was a fat finger, the mythical fat finger that explains typically everything. Some people thought that it was some sort of glitch, technical glitch. And it took like 6 months for the SEC to figure out that the apparent cause was that Waddell & Reed, a pension fund, sent a very large order to sell 75,000 E-minis with a very high participation rate. So this participation rate imbalanced the order flow. It made the order flow very imbalanced towards sell-initiated trades. And that order flow was very persistent. And that's what our algorithms picked. What you can see here is that around noon, the time when we flattened the position, this red line started to climb and cross a threshold of 90%. At 90% probability, we had hard-coded the system that the conditions for liquidity provision were very adverse. Market makers were receiving toxic order flow. What do I mean with toxic order flow? Order flow that they are not able to get rid of. It will trigger a loss in the market maker. And if you're a market maker, after you have reached a particular stop loss, you leave the market. What our algorithms understood was that when this happens, you don't want to be in the market. You don't want to be in a market without market makers. And that's why the algorithms automatically flatten the position. What I'm telling you is that, in fact, machine learning can predict black swans. I know that this would be typically a strange statement. Let me tell you how. Because we can use machine learning to understand how markets operate. We can use machine learning to figure out at what point market makers are going to leave the market. What this means is that that day, no machine learning algorithm was predicting a crash. But what the machine learning algorithms did is to tell us under which conditions market makers will leave. So in conclusion, machine learning can help us develop theories that make us understand under which conditions you want to trade or not, or under which conditions some phenomena are likely to happen. Just like the theory of relativity predicted black holes 60 years before the first black hole was ever observed. So next time someone tells you, machine learning can only predict the past, it cannot predict black swans, the answer is, when misused, you are right. When used properly, machine learning can help you understand how the system works. And once you have a theory, you run the theory. You know under which conditions markets are supposed to work correctly. Let me list 10 applications of machine learning where we have passed beyond the hype. Perhaps I should start with the most popular of all, price prediction. There are several reasons why machine learning should be successful at predicting prices. Number one, typically prices follow very complex nonlinear relations that involve thresholds. Sometimes below a certain threshold, the relationship operates in a way. Over a threshold, the relationship operates in a different way, just like during the flash crash. There are hierarchical relationships, as we saw with the example of the Titanic. There are categorical variables, as we saw with the case of the Titanic. There were no numbers, right? There is gender, there is fare class ticket. Age is a number, is an integer, or actually could be a double. But that's one example where, yes, there was a real number associated with other categorical variables. This specification is unknown. The specification could be so complex that we don't understand what are the variables involved in the price formation. There are interaction effects. So for all these reasons, there is a good justification for using machine learning in finance. Now, there is a lot of hype in the use of machine learning. I would say 90% of it goes into this pocket, price prediction. So I'm presenting this application the first because, in fact, would be the one where if perhaps we should start the last. This is the application where there is already a lot of hype and there is lesser evidence about the measurable success of machine learning. But there is very strong evidence of success in the use of machine learning in hedging. When you are hedging a portfolio, whether you're using derivatives or not, you can use machine learning to model the price dynamics of your portfolio and hedge in a very efficient way. And I invite you to read the paper published by JP Morgan last year on deep hedging. Their point is that machine learning algorithms are able to model the dynamics of derivatives in a much faster way than computational methods that use Greeks and other approaches would do. And speed is, of course, very important. That's where machine learning comes to our rescue. Portfolio construction and risk analysis is a key example. When you think of how convex optimization has been used for the past 60 years, you realize that the Markovich approach or Black-Liederman or any of the iterations of the efficient frontier deliver suboptimal results, to the point that some studies, like the one by De Miguel and others, show that the naive allocation outperforms out of sample 20 of the most popular convex optimization methods. What is the solution? Well, the solution is to understand the structure of the data. And once you understand the structure of the data, you can stabilize the problem. A month ago, I published a paper in SSRN, which anybody can download for free, where I show a very simple procedure that can reduce the estimation error in the efficient frontier by 90%. Not 5%, not 20%, 90%. Now, this procedure is really simple to implement. Anybody can do it. I'm not claiming that this procedure is Nobel Prize winning relevant or deserving. What I'm telling you is that traditional methods are so bad that even a simple machine learning method can achieve a much better results. Outlier detection. So this is very important in finance. Most of the data we use contains a substantial amount of noise. It contains noise that comes from illiquidity, observations made at different points in time, so non-synchronized data, and of course the noise embedded in financial markets. When you use traditional methods on data, whether alternative or traditional data, the results are going to be typically very poor. And I'm presenting here an example where we are trying to understand the valuation of, let's say, some stocks as a function of economic factors. The economic factors could be value, momentum, quality, liquidity, carry, all of the factors that we are familiar with. And as you can see, there are some stocks marked in red, and these are stocks that we believe to be cheap, but in reality they are expensive. And then there are stocks marked in green. These are stocks that are cheap, but we believe to be expensive. Why are we getting one-third of the investment universe wrong? Well, because 5% of the observations are outliers. 5% of observations in outliers is typically a small number in finance. 5% of outliers are making that one-third of our predictions are flipped, not wrong, flipped. We are buying things that we should be selling. We are selling things that we should be buying. Well, that's a killer to any strategy. That's why the identification of structural breaks and outlier detection is key. And this is a task where there is no alternative in the traditional textbook, in traditional methods. You need to use machine learning algorithms for doing this. For instance, what we can do is we can try a procedure called ransack. Ransack is a machine learning algorithm that is used in the recognition of images, like photos. And here what I'm going to do is I'm going to run the traditional methods without outliers, and of course without outliers, typical regression methods like the ones you find in the journals work very well. Now, zero outliers is unrealistic in finance. There will be tremendous number of outliers as a result of data reported too late in financial regulatory filings, etc. What happens when we add 5% of outliers? Well, the model breaks. And now performance has decayed from an accuracy of 100% to an accuracy of around 65%, just with 5% of outliers. What happens if we increase the number of outliers to, let's say, 10%? That's going to be even worse. What these do. Now, with ransack, what you can see is that ransack is not at all affected by the outliers. You can throw 5% of outliers, and ransack's performance is exactly the same as without outliers. This algorithm, which is very simple machine learning algorithm, recognizes the presence of outliers and cannot be fooled. What happens when we go to 10% of outliers? Ransack, unaffected. Exactly same performance. As you can see, OLS is getting worse and worse. Now, the line has an inclination of around 45 degrees. And a massive amount of stocks are being misclassified. What happens if we go to 25% of outliers? Well, now the regression line even has a zero or even negative slope. It's getting everything completely wrong. Ransack, unaffected. Just whistling around saying, throw me more, I don't care. Ransack works with 50% of outliers. Now, once we are dealing with 50% of outliers, what is an outlier anymore? 50% of outliers is not an outlier. What I'm telling you is that ransack is extremely accurate at handling outliers. And it's not even the best method out there. It's just a method that you can use in scikit-learn. It's a method that you can download and use for free. So why not to use it? Well, that comes down to another conversation we can have a different day. Why people don't use Ransack? In my opinion, it has more to do with legacy issues. This is a method that solves a key problem that we all face. Number 5, bet size in alpha capture. Suppose that you have an asset allocation. You already know how much you're going to invest in strategy 1, in strategy 2, strategy 3, portfolio manager 1, etc. Now, that doesn't mean that you should be fully invested all the time. That's something that people typically misunderstand. The fact that you are 100% invested in a strategy doesn't mean that you should be invested all the time, right? Just like you would not go to the casino and at every hand bet everything. Depending on the hand you receive, you may decide to gamble something or not. Well, the same happens with investment strategies. Investment strategies may have a Sharpe ratio over 10 years of 2. That doesn't mean that we should be invested all the time, every day. So the question is, how can we regulate the bet size given a particular allocation? And one approach is to train a machine learning algorithm that learns to predict the outcome of the underlying algorithm. So for instance, suppose that you are running a factor-based model, a model that is investing based on value, momentum, etc. Now, that model every day is making a forecast, or every month is making a forecast about what should be the portfolio that you're holding. You could train on top of that algorithm another algorithm that is predicting whether the underlying algorithm will be successful this week. And this is a fascinating way of using machine learning. Why? Because it means that you can impose a machine learning algorithm, one machine learning layer, on top of whatever you have. You can keep using your algorithms, your current algorithms. The meta-labeling, this top layer algorithm, is predicting whether the underlying algorithm will be successful. The role of this meta-labeling algorithm is not to predict the market, is to predict the predictor. And as it happens, because the underlying algorithm is a systematic method, these algorithms are typically very efficient. They are not guaranteed to succeed, but this is one reason why they are successful. Because they are able to exchange some of the recall of the underlying algorithm in exchange for higher precision. So suppose, for instance, that you have an algorithm that trades every minute. It trades all the time with a precision of essentially 50%. You know, it's just like tossing a coin, but it trades all the time. You can impose an algorithm on top and exchange some of this recall, right, some of this constant trading with a higher precision. And if the algorithm contains some information, what we are doing is we are eliminating the false positives. And therefore, the Sharpe ratio will go up, right? Because instead of trading every minute, we may be trading now once every 5 minutes. By giving up some of the recall, we have removed some of the false positives, and that gives us a higher Sharpe ratio. So that's another way of using machine learning. Number 6 is feature importance. The idea of feature importance is, can we understand what are the sources of information? Where is the money coming from? When someone shows me a backtest, I don't know where is the money coming from. Is the money coming from the execution? Is the money coming from the risk management? Is the money coming from the portfolio construction? Or is the money coming from nowhere? Is this just a statistical fluke? Is this just a result of backtest overfitting? The idea of feature importance is, can we understand what data sources are informative? And this happens in a very intuitive way. What we do is we randomize some of the variables and we observe what is the decay in the performance of the algorithm as a result of this randomization. Not performance like in a backtest, but performance like in a classification problem or computing, for instance, the AUC-ROC, the area under the curve in a receiver operating characteristic or precision recall. What we want to understand is, can we identify what are the sources that if we randomize, there is a decay in performance? Now, this is the machine learning equivalent to something we are all very familiar with, the p-value. The p-value is the traditional statistics approach to identify a statistical significance. And what I'm telling you is that machine learning has better methods that are more robust, more efficient at identifying a statistical significance. Credit ratings and analyst recommendations. So this is one of the first applications that became very successful in finance. And people typically do not appreciate that machine learning is used by all credit rating agencies. Today, when you buy a bond or when you look at the rating of a company, it is typically based on the outcome of a random forest. Yes, it is true that the rating agency has use some humans to oversee the process, and the ultimate decision depends on a human, but the heavy lifting has been done by random forest. And what I'm showing you here is a plot by Moody's. Moody's presented this example, I believe, last year, where what they show is after applying a PCA on various variables, this is the kind of pattern that emerges, where red are bonds that defaulted, black are bonds that did not default. And then they apply a linear traditional method like Probit or Logit. And what they got is something really bad. As you can see, essentially this is applying a nonlinear fit where essentially 50% of the bonds that defaulted are classified as non-defaulting, and there is no similarity between this plot on the left and this plot on the middle. And this is a result of applying a random forest. As you can see, the pattern that emerges is very similar. Sentiment analysis recommender system is another great example where machine learning is used every day. It would be impossible to process tens of thousands of news articles that are published every day on every single stock or the major stocks and keep track of whether these articles are positive or negative. Well, we can use algorithms to scout all of these articles and summarize to us whether there is a general positive or negative sentiment. Some of these algorithms actually are pretty good at identifying long-term trends. So what you can see here is sometimes there is an imbalance of positive news over negative news, like around March of 2017, and the trend lasted for weeks and months. So we're not talking about, what is the sentiment, what is the impact on price of sentiment on a daily basis. It can identify what is the narrative over the long term. And sometimes the positive and negative news are balanced, but with a spike on both sides, and that's indicative of higher volatility. I don't need to explain what is the use of algorithms in execution. Today, we live in a world where execution has been completely algorithmized. A lot of it thanks to speed and pure engineering, but also thanks to the use of machine learning. So whoever tells you there is a lot of hype around machine learning, you can say, well, talk to all these people running high-frequency trading. They have the billions to show you that this thing actually works. Application number 10 is very dear to my heart, is the detection of false investment strategies. As you know, if you run thousands of backtests, let's say that you run 1,000 of backtests, the expected value of the maximum Sharpe ratio that you should obtain is around 3.5. 3.5. There is, even if the underlying strategy has a Sharpe ratio of 0. What I'm telling you is that, of course, as a result of multiple testing, we should expect false positives. If you give me a completely random time series. Random meaning unpredictable. There is no way to come up with a legitimate investment strategy in this time series. Within a matter of minutes, I will identify to you a pseudo investment strategy with a very high Sharpe ratio, right? Because I will start just running all sorts of combinations and stop losses and profit taking and starting points, exit points. There will be some combination that will deliver an incredibly high Sharpe ratio, even though once we put that in production, the performance will be 0 or negative. So the question is, how can we detect the presence of false discoveries? And that's where machine learning is very helpful too. In this example, what I'm doing is I collected the returns from around 7,000 backtests. I clustered them, and I figure out that essentially 4 very different strategies have been attempted. Right? 4 strategies, extremely different strategies have been attempted. So now I know by how much I need to deflate the Sharpe ratio as a result of trying 4 strategies and presenting only the best one. So that's essentially, these are the applications I wanted to discuss with you today. I hope that as a result of this presentation, what you realize is that, yes, there is a lot of hype about machine learning, but that should not give us the impression that there are legitimate applications of machine learning where today we can obtain measurable better results. Thank you very much.